Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Square Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Darren Masters, professional trustee at Capital Cranfield Trustees. Welcome to the show, Darren.
Hello, Charlotte. I'm delighted to be here.
Great to have you on the show. Do tell us, what is your news story of the week?
So in a quiet week, my news story of the week was the professional pension story regarding pension schemes in-house advisors raising conflict of interest concerns.
And tell us, what was it about that story? And I know, as you say, it was a quiet week. There wasn't that many pension stories that came across our desk. But what was it about that story in particular that caught your attention?
I think for me, it was just the theme around conflict of interest, because actually it's something which is almost inherent in what we do as pension scheme trustees. And from a governance perspective, conflicts of interest is something that we face and deal with every day and pose a governance challenge. So, just looking into it in that a bit more detail and thinking more widely that actually it had relevance to other issues.
Okay, so could you maybe talk to us about the different types of conflicts of interest that you as a trustee or there are in general in the pension scheme industry?
Yeah, well, maybe just focus on this particular one for the time being, and then I'll maybe pick up on some of the others. I think the issue here just is one that is very much focused upon member interests. And when we sit with our trustee hat on, we're first and foremost focused on our considerations around protecting members' benefits and acting as members' best interest. So where you have a situation where schemes are looking at sort of considerations around endgame planning for members and have effectively a tied set of financial advisors as part of that advisory process, clearly there has to be disclosure that someone is a tied advisor. But when you're looking at potentially something that could be the most important financial decision that a member makes, having that limited set of advice and potentially constraining what members can do in those circumstances just doesn't seem like a good thing from a member outcome perspective. So that was the sort of the trigger for the interest in the first place.
Okay. And so what does that tell us about other conflicts of interest that there might be that exist as well in the industry?
Yeah, I think I mentioned this in the introduction. From my perspective, there are inherent conflicts of interest in a number of different areas. If I think about sort of the most common ones we come across, you've got situations where you have the same advisor for schemes and also the corporate. You've got situations where you have in-house teams that are advising pension schemes and pension scheme trustees. You have sole trustees or trustees more generally, where their remuneration, if they're a professional trustee, is typically picked up by the scheme sponsor. So there are a breadth of different considerations around conflicts of interest that we just face on a day in, day out basis. And from my perspective, Charlotte, because conflicts of interest are inherent things, they exist on a day in, day out basis. Conflicts of interest in those situations where they do exist can be managed. Not every conflict of interest creates a concern or a problem. They're clearly things that exist. They are most schemes will have a conflict of interest policy in place for how they operate from a trustee perspective. Where you've got common advisors, there'll be conflict of interest policies that are in place between those different parts of advisory firms. So they exist. They are there, but it's about managing them from a personal perspective.
Yeah, and I mean, another conflict of interest that maybe people kind of think about, but perhaps don't talk about all the time, is a lot of professional trustees, and you're no exception to this, are ex-investment consultants, and they might have worked with, asset managers in the past, or could, favour certain providers, TPA, third-party administrators as well. Does that sometimes play into the mix as well?
Yeah, I think it does. I mean, conscious or unconscious bias is something that we face as part of our day-to-day lives. Where you have a good working relationship with somebody, potentially where you're producing a short list, even if you're going through a formal tender process, you might consciously or unconsciously exclude certain providers just because you've got a good working relationship, a historic working relationship. But I think that is just something that, ultimately, as long as you're going through a proper process and have identified a range of alternatives, typically that should be sufficient. But if you do get to a situation where you're saying maybe as a firm, for instance, that you have a panel of advisors that you choose from, does that limit your choices? Does that give you some concerns regarding your flexibility as a trustee? And that, I think, would depend on the circumstances of each individual trustee and each individual firm. Certainly at Capital Cranfield, we have carte blanche to work with whoever we see fit. That's one of the attractions of being here.
Yeah, and so do you think that we need to take a closer look at trusteeships and how they work and how they might, to bring an investment angle into it, how they might influence the investment choices that are made, which obviously will make a difference to the member outcomes as well?
Yeah, I think there is clearly a review going on by the Pensions Regulator into what is trusteeship, what is good trusteeship, and it boils down to that key word that I mentioned, governance. We administer pension schemes for members' best interest, whether that's for DB members or DC members. We have a member focus and making sure that either we deliver the benefits that have been promised if it's a DB, or we optimise benefits or protect benefits if it's a DC scenario. So when we're considering our investment choices, that member interest bit is absolutely central to our considerations. So it's beholden to us to then consider, range of different opportunities and range of different advisors. Just because we have an existing advisory arrangement, just because we have, products on board that we're comfortable with, doesn't mean that we don't then listen to considerations around new products, around new providers, that, we canvass opinion in relation to our colleagues, the wider market. We go to conferences, listen to views, listen to ideas. None of this should ever be a static consideration. We are and should be constantly thinking about how to keep these things under review. And flipping that back to where the Pensions Regulator is looking at from a governance perspective, good governance amongst trustees and trusteeship is a central tenet of what the Pensions Regulator is pushing towards. It's driving us to be in a scenario where we improve the standards of trusteeship, and that includes looking to have sort of wider availability of professional trustees, but not just professional trustees, where you have lay trustees, that they are properly trained, properly informed to make decisions. Because again, whilst professional trustees do have a place, there's been a lot of publicity recently regarding having the member voice and having the opportunity to get members' input into this process. So it's an omnibus consideration by the Pensions Regulator about what good trusteeship looks like, with a push towards improving standards, potentially improving professionalism, improving considerations around qualifications, but just generally pushing that whole consideration around better governance, better informed decisions, but also recognising that actually you might have the best informed decisions at a point in time, but something happens from a scheme event perspective, from a regulatory perspective, and you need to adjust, you need to respond, you need to consider whether that is fit for the future.
And Jade, what about the sort of move towards trustees towards sole trusteeships? I know there's a lot of there are concerns around that. Can you talk to me about what are the concerns about the growth in the number of sole trusteeships, maybe on the DB side and on the DC side, and whether that's something we should be worried about too?
Yeah, I don't think it's not really much of a consideration on the DC side, because typically you're looking at master trust. There are sort of own scheme DC, but with the push towards consolidation, I think most of those are going to be under pressure to consolidate over some period of time. In the DB space, yes, there is unquestionably a push towards professional corporate sole trusteeship. It has a number of benefits, particularly that nimble decision-making process. You don't have to have regular quarterly trustee meetings. Your trustee board typically is a number of representatives from your own organisation. They sit in the same office or within the same organisation, and your trustee meeting can be, we've received an email with a question, we pick up the phone to each other, we have a discussion, we make an agreement, we note that down from a minute or a log perspective, and that is nimble decision making in practice. So it has those benefits. Where does it have flaws? Conflicts of interest is one area that unquestionably comes to mind, because we are effectively making decisions that potentially could be in our own best interests. We could be deciding to take our own advice effectively. Take my own career as an example. I spent 20 years in the covenant consulting industry. I could, with my trustee hat on, turn around and say from a firm perspective, I can do the covenant work that is required for my scheme. Similarly, if I were an investment consultant, I could maybe not give myself investment advice, but I could improve my scheme's investment decision making by using my own skill set, using my colleagues' input. But does that potentially create a conflict of interest because we're being remunerated for that decision making process that actually is just taking our own advice? It's not something particularly I feel comfortable around, and would always tend to seek third-party advice. So from my perspective, it has. I mean, this is partly why it piqued my interest in terms of the whole question of the conflict of interest consideration, albeit it related specifically mainly to DB schemes and master trusts. But I think it's an area where, again, conflicts do exist. Conflict management, should be a policy which sits, up front and centre of considerations around corporate sole trusteeship, particularly when it comes to considerations in relationship with the sponsor. So, it can be managed, but just need to be aware of what those risks are.
So if somebody's a professional trustee, you can be you could have small schemes, medium schemes and large schemes. Do you see different challenges facing the different sizes of the schemes? As we are the professional investment podcast in terms of the options available to those different size schemes in terms of when they are managing their investment portfolio and thinking about building that. And then also when they're thinking, which obviously is a hot topic at the moment, about the end game, as it's called, or where they want the pension scheme to go, whether it's buyout or run on or superfund or, some other option. How does that vary between the sizes of the schemes? Does the optionality really shrink down if you are a small scheme, either when building the portfolio or considering the end game?
Yeah, well, let's pick that up in two different parts. I think in terms of the investment considerations and then separately maybe the end game considerations. So I think unquestionably, if you roll back to the debate around scheme consolidation, the Pensions Regulator triggered off 7, 8, 9 years ago, one of the concerns was that schemes that were smaller, that did not have the governance budget, did not have access potentially to the broadest range of investment opportunities, whether in terms of products or advisors. So typically you might be able to get a fiduciary management mandate for 15, 20 million. Below that, very difficult to try and get a sensibly cost-effective fiduciary management mandate. To get something which is a bespoke fiduciary mandate, you're probably looking at maybe 200 million. So you're already starting to stratify in terms of your considerations around some of those products. But just generally in terms of some of maybe the esoteric private market investments, they're there in pooled funds. But if you've got a specific interest or a specific view around a particular sector, you just don't have the scale, you don't have the flexibility to potentially invest in those. So I do think on a sort of day-to-day basis, the plumbing for your investment choices, your investment decisions is not constrained, but more limited than it would be for a larger scheme. And that is just a sort of starting point, just because, as I say, mainly down to governance budgets, but also governance time. Mm-hmm. If you then go on into considerations around endgame, I think again there are clearly different classes of schemes or different stratas of schemes in terms of their potential endgame options. So, what are we looking at in terms of endgame options today? We have run-on, we have buyout, we have superfunds, and let's call it a fourth option. You have regulated apportionment arrangement, tipping a scheme into the PPF. Mm-hmm. Park that one for the time being because a lot of schemes post-trust budget, 2022, LDI crisis, scheme funding's improved. There are still schemes out there that potentially have troubled sponsors that might need to tip in, but that's a small subset. If we look at considerations around run-on, various people have different views. 200 million as a minimum threshold for a sensible run-on economically. Some say 500 million, some say 1 billion. Anyway.
It's like the joke, basically, isn't it? Ask 5 actuaries about what the optimal size is, and you'll get 7 opinions, right?
Correct. Well, I'm an accountant by training, so it's like in the old days of auditing, how much profit have I made this year? Well, how much would you like to have made? Is generally the question you used to answer. So, I think but whatever the number is, it is for the larger schemes, typically where you're looking at a run-on consideration. So below 200 million, there are whatever it is, 2,500 schemes that potentially sit in that. Well, we're running on by default because we don't have we might not be in a position where we can do a buyout. So for a lot of those schemes, certainly the sub 100 million, sub 50 million, sub 10 million, from their perspective, they're going to be looking to do some sort of risk transfer transaction as quickly as possible. If we look at the super fund market as it currently sits, albeit there are developments in this area, and I know existing providers and new providers in the market are looking to see if they can bring down the threshold. But again, you're typically looking at maybe a super fund transaction for a scheme which is 50 million. So 50 million and above for super fund, 200 plus million for run on, and everyone else looking to sort of run on by default until such position as you can get to buyout. So there is a strata of a population where, again, you've got these considerations of, could there be a different way for the smaller schemes who potentially want to be in a position where they can run on, but at the moment that market does not exist, particularly when you're looking at maybe run on productive finance investment, maybe some upside for the corporate, upside for members, for the sub £200 million schemes. On a standalone basis, that looks pretty difficult, pretty challenging for the time being. And I think, again, back to considerations around governance and governance budgets, that just doesn't exist at present.
But if we think about when the super funds sort of came to life, as you say, 7 to 8 years ago, that was long before interest rates had normalised. So It was a different world then. And the point of the super fund then was to kind of help small schemes that weren't near buyout funding get into a vehicle that would enable them to get to buyout funding and the consolidation and the economies of scale.
Yep.
And now we have this different environment. And now the people who want to raise super funds want to do something very different. It's not necessarily a bridge to buyout. It could be a run-on vehicle. Yep. In a way, it could be the ultimate vision of consolidation, because you'd be grouping all these schemes together. You don't want to necessarily pass them on to an insurer, but you want to build a situation where these schemes can all run on for as long as they like in perpetuity. And that, I think, is a really interesting shift of landscape and competitive landscape. And it's kind of galling for the guys who started the super fund under a different regime because the goalposts have changed. But does that represent a really different opportunity for some of these smaller schemes?
Yeah, I think it does. I mean, you're right. If you look at the derivation of where super funds came, or sort of other consolidation started, it was envisaging effectively grouping together schemes with active sponsors, in what we would have described, and that they still exist, the DB master trust environment. Mm-hmm. Super funds came in an environment where you were looking at schemes where they had potentially distressed employers, were not likely to be in a position where they could do buyout. And I think until we did the first connected covenant deal, there was nothing out there other than through two schemes were distressed. One was a sort of first one for an active sponsor, but they were typically for those schemes where there was potentially threat ultimately that if the sponsor went bust and there was a risk of the sponsor going bust, that you could find yourselves in a situation where members' benefits would be impacted. Yes, post 2022, the position has significantly changed. So a lot of the market, I was working on a transaction in September 2022, pretty much had pre-clearance, got to a situation where we retested the funding level post the mini budget, and we'd sailed through gilts plus a half. So when you had those hard and fast funding triggers or gateway tests in relation to the existing super fund, we just couldn't meet them. We were not able to do a transaction. Mm-hmm. It's a good thing the scheme was actually able to buy out, so it wasn't they particularly lost out from a member perspective, but it changed the goalpost in terms of what was being proposed. I think if you look at the way things have evolved, I think it's just a recognition of the fact that most schemes have had that bump in relation to funding level. So if your target market has changed, potentially your considerations around how you look at your super fund changes. So you're moving away from the sort of, let's just do the best in terms of, securing members' benefits, aiming towards a buyout type funding level. But is there an alternative to properly consolidate? get that investment infrastructure, and take one of the providers we know is out there in the market. They already have that investment infrastructure. They are a fiduciary manager. They've got their own DB master trust. They've got the plumbing in place to sort of bolt on these schemes and the investment structures behind them. Again, giving some of the access to that investment breadth and depth that we were talking about that typically those small schemes don't have. So if you can do it at scale, you can do it economically for those smaller schemes, that provides potentially a great opportunity to run the scheme on with that good infrastructure of investment behind it to potentially deliver improved member returns. Obviously, if it's in a super fund structure, it doesn't potentially deliver anything back to the scheme sponsor because they're typically paying a price to sort of seed it over to them, but potentially then delivers a return to the super fund provider, which in turn maybe enhances position for other scheme members if it's wrapped within a structure which is also a DB master trust or a provider of pension. So it has some attractions to it from a general perspective, but absolutely unquestionably change the goalposts.
Yeah, and I wonder, when we talk about consolidation, I think you could argue quite, coherently that actually buyout is a form of consolidation. And I've noticed that the news stories I've seen about buyout deals at the moment seem to be on the smaller scale. We seem to be seeing a lot of smaller buyout deals at the moment. So, and I know that was an issue in the past, that smaller schemes felt that they didn't have access to that market. So that market does feel like it's opened up. I know there's been a drop overall in the number of buyout deals. Well, maybe other larger or medium-sized schemes are kind of cogitating between buyout and run-on.
Yep.
So do you think as a trustee, that must be like a major consideration if we forecast forward into the future that we have a new super fund that's going to target more of a run-on than a bridge to buyout model? As you as a trustee of a sort of small to medium-sized scheme, which thinks it's going to be better off in some form of consolidation, how do you then think about, would that scheme be better off with an insurer, or would that scheme be better off in a super fund? And does the investment optionality of those two pathways factor into that consideration?
I think investment optionality is part of it. But I think the most important consideration is any end game plan for a scheme has to consider the whole smorgasbord of options that you've got out there. You can't simply turn around and say, we think buyout is the best option for this scheme because it's a small scheme and we've got a sponsor that wants to go from a buyout process. That's not the only consideration here. I think TAS 300. I'm not an actuary, so I won't go into too much of the technical details on this. But we are beholden as trustees to consider that wider range of potential options. And actually, again, what I mentioned earlier on, from a member benefit perspective, if we're thinking about members' best interest, is a pure buyout without maybe some member upside something that is in the member's best interest. We might do a deal at a particular point in time, cap members' benefits, close off discretionary increases, or we might go into a structure where we're potentially less protected because it's a 99.7% probability that we'll meet members' benefits in full, maybe than a 99.9 from an insurance perspective. But there's member upside there. So is that an influencing factor that says to us, balancing that extra return to members, balancing those broader considerations around maybe some benefit to the wider economy in terms of maybe some greater private market investment in there. All of those are relevant considerations that we would take into account. But with a primary focus, let's just not drop the ball from a member perspective, because the last thing we want is the old Daily Mail test. 5 years ago, Mr. X took a decision to place a scheme with this particular structure. Looked very, very interesting. Met all the approvals at that point in time. Seemed the right decision to take, but with the benefit of hindsight, should have gone from a buyout. So they are nuanced considerations. They are the type of things that we will consider and should consider from a trustee perspective. But effectively we've got, it's 5,500 schemes are going to require 5,500 considerations of the range of options to come up with a bespoke one that works for each individual scheme.
Yeah, well, that's what if you talk to anybody like you or anybody else, or even the trustees or anybody who lives and breathes this world, they all say that you just can't do anything that's too prescriptive. That each scheme is so unique in its own variety, in its own particular challenges, which, I mean, if something was prescriptive, it'd be a lot cheaper and easier and more economical to push everybody in one, two, or three directions. But having to have that level of understanding of the unique challenges within each scheme just makes it more complex, doesn't it?
It doesn't, and that's the nature of the sort of the trusteeship challenge, and why, again, even at the sort of smaller end, governance is so important. You are sitting here with trustee and rules as your principal document, but on top of that, your considerations around investment, etc. Governed by legislation, Pension Schemes Act, whole raft of regulations, laws that just mean that what every decision that you're going to make is prescriptive, not prescriptive, is subjective based on each individual scheme. I think whenever you talk about considerations around prescription, I mean we've had the debate on Pension Schemes Bill about mandation of investment in relation to private markets. When you tell someone they have to do something or must do something, or you be prescriptive about it, it creates risk, it creates unintended consequences. So as long as you're taking decisions with that, the benefit of all relevant information and ignoring irrelevant information, and you've got an audit trail, you can explain why you've done something. If someone says you'll do something, then frankly we don't have a role in that circumstance. If there's prescriptive or there's mandation, why are we here as trustees? What is our role in those particular circumstances to implement something that someone said is to be done regardless of the consequences?
So, from your perspective, I mean, what is it? Can you give us some examples of how schemes differ? I know that's a bit, so I haven't really rehearsed this with you, but if you could just think of some ways that, like, one scheme might have this and one scheme might have that, or I'll give you an example to give you a bit of thinking time, Darren.
Yeah.
But we were at a conference recently, and somebody was talking about releasing the surplus, and it was like saying, well, you might think it's releasing the surplus is a good idea, but it might be by the time you've divvied it up amongst the members, it's 150 quid each, and it's just not worth the hassle, for example. Yep. So what are the kind of, like, if you could give us some examples of how much of a spectrum there is for different scheme characteristics?
God, how long have we got? I mean, the
well, we're near the end of the podcast, so not another half an hour.
the answer is there's a massive disparity. I mean, take even on something simplistic like the valuation. Who agrees the valuation? Does the scheme rules prescribe that it's the trustees who have control of the process? If it's anything other than that, then it's likely to be consultation between trustees and the sponsor. Certain things, regardless of what scheme rules say, there's statutory override. So potentially there is conflict between trust scheme rules. So maybe around the investment strategy, fettering of rights. I mean, a classic one is around pension increases. Different rates being used, different categories of members. I mean, I had an example the other day. We were talking about considerations in relation to release of surplus. Enough of a surplus to make a difference, so it's significant from a member perspective. But we have 4 different classes of benefits. 3 classes of benefits all had some form of pension increase, or marginally different. One was an RPI capped at 3, one was a fixed 3, and one was a CPI based. But pre-1997 benefits were non-GMP, and any increase on those was discretionary. So anyone who's in that sort of non-GMP 1997 class, you'd think from a sort of sensible rateable protection perspective, they should get a fair or bigger share than maybe the guys who have already got some pension increases built in. So those are just like a few sort of very small examples, but how big's a trustee board? How long's a piece of string? In terms of the number of different types of scheme structure and different scheme rules. It is, and that's why I think it's when we talk about these endgame solutions, there isn't a one size fits all. We've got 4 sizes fits all for the time being, but it's 4 sizes to fit in 5,500 different unique circumstances.
Yeah. Well, mate, that makes me feel tired on your behalf, Darren.
it's a great place to operate. But that, again, it's why we do the job. It's why we have a role as trustees. Our role as trustees is to administer the benefits for the members in accordance with the scheme rules and with overriding legislation. And every one of those decisions, therefore, is quite nuanced. And that's why there is that push around professionalism. That's why that's that consideration around managing conflicts of interest. So I think the sort of the genesis of this discussion and news story was really just thinking about actually this is conflicts of interest is a trusteeship issue. It's a pensions wide issue, and it's something that can and should be managed. But it actually just creates a unique debate on a scheme by scheme basis.
Oh, that was beautifully done, Darren. Very well done, because at the end of the podcast, you've looped us back round to the beginning. Expertly done. Do you want my job? It's almost like I've done this before.
It's
almost like you've done this before. It's almost like we talk together almost every week, it feels like at the moment. Did you want my job? If it's too much, if you've got too many different things going on, you're now auditioning to be a journalist. Well done, Darren. So I think that is a fantastic spot for us to leave the podcast. I just want to say thank you so much to Darren for your excellent insights and contribution. I really enjoyed that. It was a fascinating conversation. Listeners, if you want to make sure that you never miss a future episode of the Professional Investment Podcast, make sure you hit that subscribe button and do interact with us. Take part in the Spotify poll if that's how you consume your podcast. And thank you for listening.